Cool. It's like a real webinar. Okay. And Mr. Roboto will read off the thingy, and then we'll be ready to go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, and registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website www.optionsclearing.com to read the characteristics and risks of standardized options. PSW provides education and training services determined to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Fantastic. Gotta love the technology. All right. So, where are things? Oh, we got important stuff going on. Okay, oil just hit our goal at 52.50. I have 5 shorts. Now, we know for a fact, no, not for a fact, we know for a high probability that oil is going to bounce off of 52.50, okay? How high is it going to bounce? Well, 5% rule. We topped out at 53.75. We dropped down to 52.50. 52.50 is $1.25 lower, so 20% of $1.25 is 25 cents. So we're going to bounce to 52.75. That's our first bounce line, and our next bounce line is 53. Now, I have 5 contracts short, which we've talked about since yesterday, and do I want to watch them bounce $1,000 against me? And no, I don't really, so I don't think there's any point to this. So basically, I think I'm going to take my profit here, and I'll enter another trade if we break below this green line. But also, you see this green line of support too? It's very unlikely that we're going to smash through that in one session. So I'm going to take my profits. Ow. I hate it when it doesn't fill. Come back. Now, see 35.38? So I'm thinking I'll get my fill. 35, 38.27, 41.32. There it goes. See, I got my fill. So now I'm down out of 2 of them, but unfortunately went back up. 72.8, there you go, 75.7, that's still in my favor for down. 54.32, a little bit in my favor for down, but let's not be greedy and take 52.60. Okay, so now I'm clear to this contract. Now, we're watching for a weak bounce to 52.75 or a strong bounce to 53. At 53, I'm going to be enthusiastic about getting back in for short because I would have missed the bounce. It would have cost me $1,500. But at 52.75, I'm just kind of watching and waiting. And what I really want to do is see it actually break below 52.50 and then get back into some shorts. Now, meanwhile, if you want to play along, I like silver on the 16 line. And 16 is center line support right now. If you're going to play silver, you got to watch the dollar. So So what's the dollar doing is the question. And there's the dollar. The dollar bounced off its support. See also bottom line support. So the dollar bounced off support here at 102.7. Now, also what's going on in the world? Well, Monte de Pesci Bank tried to recapitalize some debt and nobody wanted to buy it. So they crashed out today. Hang on, I don't even know where you're closed. Hold on a second. Let's read. Europe did not close that badly. Okay, the banking sector really dragged everything down in Europe. So we will see how it plays out. The bottom line is that's what's been messing around with things today. So the dollar the dollar sold off a little bit just because it was so overbought yesterday. We knew that was going to happen. And same logic as yesterday in the Morning Post. So I like silver here at 16, but it's been nasty because yesterday we picked it up at 15.75. So you got to have a tight stop below 16, and then we want to jump back in around 15.75, or if this line holds, which is 15.82. All right, so that's going on. Now gold. Here's gold. Gold's not doing anything. It's flat. Okay, but that's good, because if gold's flat and silver's flat, and they both their little pink lines here, they're center points, then probably I can just keep an eye on both of them, and as long as the dollar doesn't go higher, we should be in good shape on that trade. All right? And again, bank failure, silver and gold, good bets anyway. So let's get back to this. And I certainly have the confidence to add one. I usually play two, though, but let's see which way it goes before I add another one. Oil, not very bouncy. And this would be a good time to check out our inventory report. But first, let's see if anybody has a pressing question. No pressing questions. Looks good. Okay, well, okay, everything's good. So, inventory. PETROL. Petroleum status report. There you go. Gotta love Google. Now we have our 1 o'clock reports out, and we had some weird stuff going on, so we're going to take a real close look at this today. And for a close look, why don't we do a close-up? There we go. Okay. Blah-de-blah-de-blah, don't care. Here's what we care about. Yeah, look at that. See, here's what happened. All other oils, that weird category, dropped 10.5 million barrels. We don't know what all other oils are. As I expected, though, we had a huge amount of exports. We exported 2.76 million barrels a day. So let's see. $2.76 times 7. We exported 20 million frickin' barrels of oil. We only import net 4.5 million a day. We are energy independent. You know, this thing about making America energy independent is really stupid when we're only net importing 4 million barrels a day. Okay, so we import 20% of our oil, and it's not even as much as Canada and Mexico send us. So most of the oil that we import is so that we can flip it around. Well, not most, but well, 1/3 or whatever. But a third or 40% of the oil that we import, we're just importing it so that our refineries can refine it. It's got nothing to do with the needs of America. We're energy independent otherwise. You know, we're not relying on OPEC. Canada's not going to cut us off. Mexico could cut us off, and they should cut us off. That'd be funny if Mexico stopped sending oil to America if we put up a wall. Anyhow, so net, we had a build in crude, 483 to 485.4. We had a drop in gasoline of 1.3 million. You can see that there. We had a 2.4 million drop in distillate. We had this mystery drop in all other oils. You know, with no, it's all weird oil stuff. I can't even imagine what they're doing with it. And the SPR is flat as a pancake. So, net, we're down just about 12 million barrels for the week. That's a big draw. And we want to see what happened, though. Was it demand? Here's question number one. So was it demand? Here's how much we supplied. The refineries made less gasoline than last week. The refineries made a little bit more distillate than last week. And the refineries made the same, a little bit more all other products. That's kind of interesting, right? So, and you can see here, the net change here of supplied product is only 300,000 barrels a day. In fact, look at last year. We're less than last year. We're using less product than last year. So this draw is almost certainly just moving some barrels around somewhere. And there's a big gray area because, you know, the refinery, okay, think about a refinery. Okay, the refineries as a total, right, are moving these are pluses because this isn't a total. They're wait a minute. Okay, input to refineries. Okay, so they're moving 16 million barrels a week in the refineries. So that's throughput to the refineries. And 19 million barrels is coming out. So they're working off, they have internal inventory in these refineries that they're using, and that may be when they do their counts, that could be where these mystery counts come from. I wouldn't put too much stock in that unless it's a trend. And as you can see, we still have a lot more other oils than we did last year. I guess maybe some kind of heating oil or something is in this category and people stocked up for the winter. That's possible. I think if I had to guess, that'd be the most likely thing. Is that this is like, I know people who have oil heaters this time of year. They fill up their oil heaters, and maybe that's what happens. Maybe there's always a drawdown this time of year. I don't know, frankly. But the bottom line is, we are exporting a crap load of oil. We're exporting 20 million barrels basically a week of oil. I'm sorry, refined product, not oil. Refined petroleum products that we're exporting. And we've got a crap. I mean, look, last year, 1968, we had too much oil last year. Now we have 2023. That's 55 million barrels more than last year. So there's still way too much oil in this country, and that's why we like the short on the oil. And I still like it. Like I said, I only took it off because I expect it to bounce, but it's not even bouncing. Oh, frick. It's not even bouncing. It actually is going lower. So now, this is 52.59. We're still not really, I'm sorry, it's right where it was, actually. I'm expecting a bounce off the 52.50 line, and we're not getting it. So maybe I got out too early. Silver, on the other hand, is heading lower. So does that mean the dollar is getting stronger? Let's look at the dollar. Yeah, so the dollar is getting stronger, and that's pushing stuff down. So it's not fundamental. This is not fundamental. Part of this is not fundamental. Part of it's the dollar getting stronger, but also it's fundamental. This is way too much frickin' oil. There's so much oil that we've become a massive exporter of petroleum products. That's the bottom line. The easiest story to tell. Whoa! Boy, did I get out too early. Damn, please don't go right through that. That'll piss me off. See, now we're below 52.50, but I'm still fairly sure we're going to bounce, even though we're bouncing a little lower than I thought we were bouncing. Meanwhile, the Russell, so that's up a bit today. There's 5 short contracts here at a 1383 average. Not very exciting gain so far, so we'll see what happens. What I do is every time it bounces up to this line, I short a couple more. Then when it comes back down here, I take them off, and then I shorten, and I take them off, and I shorten, take them off. So I keep raising my basis, and my basis is now 1383. I'm just waiting for the big crash to come at some point. So silver was my one contract. I really wouldn't look to add. This is 16. This is 90, and this is 80. So really, unless we came back down to 80, I don't have much interest in adding. If I added 80 and my average is 15.90, I'm pretty happy with that for a long-term play. And then I'd stop if we went like below 75 or something like that. Or no, I probably wouldn't, frankly, because we already held that. So we'd have to go way down here before I really stopped out. Oh, no, come on. Every once in a while, oil like completely fails and sells off massively in one shot. And I'd be annoyed if this is one of those shots and I just dumped 5 contracts. Not even a bounce? I mean, come on, guys. Come on, NYMEX traders. Let's do something. Okay, I'm rooting for oil to go higher. Meanwhile, the poor Dow. Holy crap. That's not good. So close. Look at that poor thing. So this is not, obviously the futures are not the same as the index, but look at that. Oh, he tried so hard. so hard and it's not working. Did you buy SI? Yeah, I just bought SI right on the thing there. Phil, are you bearish on IWM? Yeah, I'm bearish on IWM. We were just talking about that. Is January 17 SCO spread still on? Ooh, where is that spread? Are you expecting the crash you're looking for, Phil? I'm still expecting. When are you expecting it? I think the only thing that makes sense to me at the moment, and if you're going to look for something sensible, and I'll talk about like how it's being manipulated to make all the portfolios look pretty and blah blah blah. But what makes sense to me, if you want to say what's motivating the consumer at this point to buy stocks, aside from the fact that bonds are horrible and people are trying to figure out what to do with their money. You have to imagine that somebody who's made a lot of gains in the market this year, and a lot of people have made a lot of gains in the market this year, they don't want to sell because, in theory, capital gains taxes and the regular taxes are going to be significantly lower next year. So, let's say you think your taxes are going to be 10% lower next year. Then even if you expect a 10% correction, it doesn't make any sense to sell your stocks that you have gains on, right? So depending on where you are as far as how much you've made on your stocks, if you're going to make an extra 10% because your tax bill is lower, then you're not too psyched to sell anything right now. So, and that's what we have. We have a very low volume rally, and it's really due to a lack of selling, not so much a rush of buying. So in absence of selling, anybody who wants to buy something has to keep paying up because there is nobody selling. Like it's an auction. I mean, the stock market is an auction. So if there are no sellers, then the buyers have to pay top dollar to shake out some shares. They have to find a guy who goes, okay, well, for that much money, I'll sell it. And that's what the game is. Now, the problem is that when sentiment changes and all these people turn around and say, okay, now I want to sell, that's a total disaster. Now, it won't be horrible if people just sell because they want to cash in after January 1st, right? That is, as long as they sell normally. But if there's something bad happens and people start panicking, then they'll find out there's no real buyers. And if there's no volume of buyers, then it goes the opposite way. Now you have to try to sell, and there's no buyers, and it gets bid down and down and down, and you keep trying to offer a price until somebody finally goes, okay, I'll take it for that much. But that much can be 10% down, 20% down. Clearly, if there's no volume of buying, and let's see if we can find a chart that shows that. Oil is totally breaking down. I am so mad. Anyway, all right, I did the right thing. I locked in my gains. Let's see. But I won't chase it. I mean, now if I missed it, I missed it. And by missing it, I mean I made $3,500. So, anyway, which one's it? Yeah, there you go. On the nose, $3,500. So we'll see. Oh, I'm sorry. Let me ask about SCO. SCO spread. Where do we have an SCO spread? It's not in the long-term portfolio. I don't know if I officially added that to a portfolio. Oh, no, there it is. So we have a spread, which is short oil. It's an ultra-short, SCO, 65.70. We paid net $2 for it, and it's $1 in the money. And we think oil is going lower. So, yeah, no reason to change that. Now, currently, although we may want to consider, if oil's not down, next week after Christmas, if oil's not down significantly after Christmas, we might want to take this money, because it's $4.25, it's twice as much as we paid for the spread. We could take this and roll it to a longer-term short. But time frame-wise, this is when I think oil is going to bottom. Maybe February, but I wouldn't want to go too long on this because then our premise flips anyway and we're long on oil. All right, we're long on oil into the summer. I mean, same as last year. I just wrote about that this morning. It's obvious that oil will be pushed up into the summer. So I wouldn't bet against it in the summer, but right now it's being stupid at 53 or whatever it is, or 52.50. Please review Kate in the OOP. Is this the OOP? Yeah, this is the OOP. All right, Kate. Kate. There's Kate. I don't know what. I mean, the 15-20 bull call spread. The stock's at 15. It's 2018. We're not worried about it. And we have 15 short puts. So all we're saying is we expect it to hold $15. That's our bottom line. So if it's lower, it gets assigned to us. And we think it's going to go to 20. We think we're targeting 20. And if it does, we sold. The spread turned out to be net zero. So if it works out, it'll be a full $5,000 profit off of a net zero cash outlay. And the worst case scenario, of course, is owning Kate owning 1,000 shares of Kate for $15. That's our worst possible case. So I like this trade. It's a really good trade. Oh, that should be gone. This one's much more oh wow, this one's more. Oh, I see. That's why we don't have as much money as I thought we had. This spread should be netted out because these expired worthless, and this spread expired at 5,000. Yet for whatever reason, it's only showing 2,300, which is weird and silly. But I guess that's just because the price is zeroed out. That's why. Okay, because all the price is zeroed out because I didn't cash out that trade yet. I have to put in a thing to execute it. So anyway, so that's why I was wondering why our portfolio went down, but that's because it still has the adjustments made, which I have to do this weekend. NG's up strong today, time to short. Although it's tempting to short, I'm not short. I like natural gas long. So I don't just flip around and short. You know, look, if I like something, I'm not going to flip around and short it just because it had a good run. I like natural gas when it goes down. I like it long. When it goes up, I'm not going to play it. I mean, if it consolidates along 350, I'd play it. I still think it's going to go to 4 by the end of the year. So it's still frankly a good play. And we still have those July natural gas contracts. So, I don't have any reason to even take them off the table. If it does go back below 350, I'll stop out at least half of them. But we're long natural gas. We're not flipping short just because it had a good run. It's well deserved. If they sell next week, won't it settle in 2017? I don't know. That's a broker question. I don't know. I would not do that. I would not mess around with settlement dates. Frankly, for tax reasons, if I got to sit there, I mean, why would I want to have to worry about what the IRS considers a sale date or not? I mean, I imagine, if there's funds and the funds are selling and they have a settlement dates and whatever and they execute, yeah. I mean, certainly some people are going to play that game. But as an individual investor who has to report his taxes, I'm going to wait until January 1st to sell my, if I want to take a loss in 2017, I'm going to sell in 2017. Exxon went from 30 to 22. I'm out and made full money. Yeah, you got to wait for Zika to come back. It's not Zika season. You got to wait for things like that. IRS is based on trade date, not settle date. Yeah, I figured. Okay, yeah. I do understand. I mean, I understand some people have settlement dates and the funds settle some certain ways and whatever, but that's not my hassle. It will be next year if we start a hedge fund, but right now I'm not going to worry about that. So what else is going on? All right, so the 5% portfolio, good on track. The short-term portfolio, 335. That's not good. 335%. So we're only making 100% a year on that one now. And the long-term portfolio is still just under 140%. Like the Dow, it could not close the deal at 140%. That's just massive, because this is our big money portfolio. We started this one with, the short-term portfolio started with $100,000. It's now $400,000. This one started with $500,000 though, because this is our main portfolio, and we're up to $1.2 million basically. So that's nice. That's $700,000 gain. So, it was good to be bullish. I just don't like maintaining all these bullish positions. It really drives me nuts. There's too many bullish positions, frankly. And, so I'm just not that confident in the market. I don't think it's going to sustain itself. Oh, now you're looking a little bit bouncy. Okay, let's see what happens. So in the 5% rule, it's very important to ignore things that spike past where you're going. You know, if it reverses quickly, then you just ignore it and say, okay, 52.50. So it can go down to 52.30 something, whatever it was, and goes back to 52.50. If it does it quickly, I still consider the line 52.50, which is here. Okay, just because it goes below your line. And a lot of people are very literal about these things, which is not good. Just because it goes below your line doesn't mean the line didn't work. Okay? Stocks don't know what your line is. So they'll go below it, and they won't think twice about it. Nobody's watching your line. It's an arbitrary line. Always remember that. In fact, I wrote an article called The Microwave Oven Theory of Investing, which explains that. How basically it's like, because the point of it was, you know, when you put a pizza, you take a piece of pizza, leftover pizza, and put it in the microwave, right? And you push the 1 minute button or the 2 minute button. Now you know, first of all, you know a minute is probably not long enough for a slice of pizza, and the 2 minutes is too long, and you're going to boil off all your cheese. So somewhere between that is the right number. But if you use a dial or you punch in a number, you tend to pick an arbitrary number or some number you think is going to work. But every slice of pizza, unless you're buying from the same place every time, every slice of pizza is a little bit different, and they're not all ready at the same time. You won't know that until you watch it and you see how the cheese gets a little bubbly or something like that, and that's when it's ready. Unless you sit there and stare at it, that's what you do. But the problem with people is you have this bias that once you pick a number, so if you pick 1 minute and 36 seconds for whatever reason, or 133, I think people tend to do 133. They tend to push the next number twice, or they'll push the minute button, like I said. But if you push 133 or 144 or whatever, that's an arbitrary choice. And even when evidence to the contrary, even when the pizza doesn't look ready or does look ready, people tend to stick to that number. And you'll stand there, even though you can tell, you're watching the thing spin around the microwave, even though you can see that it's totally ready, you still wait for the stupid beep that you picked. You still wait for the timer to run down to 0. Makes no sense. Ready is ready. You open the door, take it out, it's done. But that's the same thing people do when they invest also. When you pick these lines, that's why I'm not a fan of these kind of lines because, frankly, I mean, I like them because I watch what everyone else is looking at. But the problem with these lines is that once you pick them, you end up making trades off them as if they mean something. But they don't really. They only mean something because a lot of people trade it and act like it means something. You know, in other words, it's every time there was a full moon, IBM dropped 5 points and the next day it recovered. If that happened 20 times in a row, I'd start betting on it. Obviously, there's no correlation between a full moon and IBM dropping, but if everybody starts believing that's a signal, then they'll start playing it that way, and then it'll get even, and then it will self-reinforce. So, you know, you have to be careful of all these market signals, especially when you start trading on them, because you have to start thinking, like, where did this thing come from? Who said this is the right price? Who said this is the thing? You know, as you guys know, I'm a value investor. Okay, so for me, I know 52.50 is too expensive. I just also know people are going to buy off this line. So even though it's too expensive, so what do I expect? So now we go into a rule, though. Now the 5% rule tells me that a drop from 53.75 to 52.50 is $1.25, and a bounce. A normal bounce is 20% of the drop, so that's 25 cents. So now I know that 52.75 is my first bounce level, right up here. And if it fails there, that's a weak bounce failure, and that means it's probably consolidating for a move back down below 52.50. But the first reaction to this line, which we're still not back over 52.50 yet, but the first reaction to this line is usually at least a weak bounce and possibly a strong bounce. A strong bounce will be another quarter up to 53. So that's what we're watching for now, and that's why I got out, because I got out because we had a quick bounce back, and I'm watching the thing drop $1,000. I'm like, what the hell am I doing? Why do I want to watch myself lose $1,000 of my gains when I have this lovely $3,500 gain to lock in? And on the Russell, it's the same thing. Says I'm kind of like I want to ride these my five main contracts. I want to take them down to, and by the way, they cut the Russell in half as far as the payoff. So it's like having 2.5 contracts of the old ones. I want to ride these 5 contracts down to like 1350 at least, which is way down here. So I'm basically expecting from 1380, 1500 a contract, $7,500. I'm expecting $7,500 off of this set. What I do is, like I said, every time it goes up here, I'll add 2 more shorts. Then it comes back down here. I'll buy that to 2 shorts. Goes back up. I add 2 shorts. So if anything, my theory is it won't go higher than this. And if I end up lucking out, there'll be a sudden crash, and I'll have more than I expected. But at no time do I not want to be short the Russell, because as I wrote today and as I wrote Monday, the Russell is unbelievably overpriced. You got 2,000 stocks in the index, 1,500 of them are stocks you wouldn't, if you looked at them, you would never buy them. That doesn't matter because people buy the index. You know, these are 2,000 small cap stocks. So and don't forget that if the stock does well, I made this point this morning, if the stock in the Russell does well and makes a lot of money and gains market cap, they kick it out of the Russell. So all the best stocks get kicked out. These are all the ones that don't do well enough to make the mid caps. So I don't understand how it can get driven up to this kind of height, but it's just following everything else, really. I mean, there's no good reason for it. I mean, we look at the overall charts of the indexes, dailies, and it's just basically doing what everyone else is doing. It sold off worse, and it came back further. But basically, they're all up here. You know, look at the size of that, size of the other. They're all up that high. So it's just following everybody else. Money is coming into the market, and the thing is, since this is such a small index, unless you purposely allocate a very small amount of your portfolio to the Russell, it's going to get too much money flowing into it. And that's what they call the dumb money. There's not much picking. You know how it is with a 401k or an IRA. Some salesman comes to your office and he tells all the people in the office, well, we have these 5 ways you can invest in the market. Pick one. I mean, I've never seen it. I freaked out when I saw that. I used to have this company. I had 100 employees, and we were setting up this 401k program for them. And I had to go through like 5 different brokerage places to find one that had a reasonable plan for the money. Because I was just shocked. They ended up using Fidelity because they had a pretty good choice of things. I was just shocked at how poor the choices were from most funds. They come by and like, well, we put all your money in the S&P, so how much do you want to put in the S&P? I'm like, well, what if I don't want the S&P? What if I want material stocks? What if I want energy stocks? What if I think something else is going to do well this year? He's like, oh, well, he's like, hey, you don't want to do that. You want to stay diversified. I'm like, no, I want to play sensible. I want to play sensibly into the rotation of the broad market. You know, they're just not geared up for that. Not only are they not geared up for it, they don't want you to win. They want you to buy everything they're selling. And by getting you into the index funds, that's what you're doing. They've got private clients who they're working rotation schedules with. And by having you dumbly just dump your money into indexes, they know exactly how much money is coming into the index at the end of the month, and they know exactly how much they can put their guys into selling or buying ahead of that money. That's the smart money moves in. They know how much money you're going to be buying of every single stock. Because that's your flow. There's very little variety to what comes in the flows of these index funds. So they're either trending up or they're trending down. But the gist of it is, every week, everybody in America has paychecks, and their paychecks go into the IRAs and 401ks, and those things buy the indexes, and the indexes reliably buy every frickin' stock on the market in various proportions. And those brokers know pretty much to the penny exactly what you're going to be buying a week or a month before you buy it. So how much of a disadvantage do you have when you buy into these funds? That's why they love doing this stuff. That's why you see this crap. Look at this. Down. Here you go. Beginning of the month, down. Beginning of the month, down. Right up. Right up. After that, beginning of the month, down, 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 up. Okay? That's these guys sell, and the dumb money buys, and these guys sell, and then they get out, and the dumb money buys, and they sell, and they get out, and now they're selling, and the dumb money's buying, and they get out. We're just, you just can't see the next leg. But that's where we are now. Let's see. Comcast butterfly trade would be good candidate. How can we set it up? Comcast, didn't we talk about that in chat today? CMCS. Oh, okay, yeah. I said it's a good butterfly candidate, but this is a trade. Okay, so it's not it's not okay. All right, I'm assuming you don't understand it by the nature of the question. Let's see. The point being, if I'm going to play Comcast, I'm not bearish on Comcast. I think they'll go back to 67. I think they'll go back to like 65, and then still go to 70 by the end of the year, next year, or 75 even. I mean, whatever. But so 70, 75 next year is where I think. I think they're a bit high in the channel now, just like they always are. They're high, they come back down. 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 They're high. Okay. So given that they're high and they come back down, 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 and now they're high and they come back down, and here they're high. What do you think is going to happen next? Just guess. It's not hard. It's not a trick question. What's going to happen next? They're going to come back down. Okay, so A, not the best time to go long on Comcast. B, that's number one. Number two, if I'm going to set up a butterfly, where am I going to set it up? I'm going to set up a bit lower than it is now. So I said we'll sell. Step number one on the butterfly, what are you going to sell? I'm going to sell a 67.50 puts and calls for a whopping 740, which is a huge amount of money. Now, I'm not bearish on Comcast, so I'm just going to buy a bull call spread, the 65.80 bull call spread, which is only 650. So you're collecting more money than you bought the spread for in your first try. I'm not going to sell a put. I don't want to buy a put because I'm not bearish on Comcast. I don't think Comcast will go down low enough for me to be worried about the short calls and short puts I sell. We have trades like that in the butterfly portfolio. I'm too bullish on this stock to buy a put. I'm not going to waste my money buying a put when I don't believe it. Now, on the other hand, though, since we're high in the channel, I'm not going to sell a put. So my plan here is I'm buying the bull call spread. If it goes lower, then I'll sell a put. Not buy a put. I'm going to sell a put if it goes lower. I do not believe there's a big downside to this stock. So there's no reason I want to buy a put. Why would I waste my money buying a put when I don't believe it's going lower? And lower, by the way, I don't mean going lower than 65 or even 60. That's not the point. The point is if I'm selling 65 puts and calls and it goes for $7 and it goes to 60, I'm still up $2. So that's not I'm not worried about the range. So as long as my range is between 60 and 75, I'm good on this trade. That's what I'm betting on. So it would be pointless to sell a put. To buy a put. And I thought, so why would I sell a put when I think it's going to eventually drop $5 or $10 on me? That's when I want to sell a put, when it's good money. Not to mention the fact that the VIX is incredibly low and gives you terrible prices for all your puts. Look at that horrible thing. So I'm getting very bad pricing on the puts. It's a bad place to sell the puts, so that's how I do it. So when you say for a butterfly trade, that is for a butterfly trade. Okay, that's it. It's just not just because it's, I know the butterfly type of trade doesn't have to be set up the exact same way. The point of a butterfly trade is that you're selling the puts and calls. How you construct your long depends on how you construct your long-term position depends on what you think the stock is going to do, where your danger zone is. You want to protect yourself. Right? You don't protect yourself against nothing. And again, it goes back to being a value investor. Okay, when I look at this chart, not that chart, why is Trump talking? When I look at this chart, I don't, first of all, it's a rising CMA. I know the earnings are going up, and it's basically staying at the same general 20 times earnings sort of thing. I think they're a good company. I think they'll be in good shape going forward. So I look at this chart, and when I see a dip, I don't see a dip to here. I see a dip to a buying point, and then it goes up, and I see a dip to a buying point, and then it goes up. So the next buying point is probably 62.50 or 65, and it's going to keep going up. So it's not an arbitrary thing to me. I don't think there's any reason to protect from the downside. It's like if something was falling, and here's the ground, and you say, well, how far is it going to fall? And you go, oh, well, let's see, the ground's at 62, so I think it'll go to maybe 50, 58. It's like, no, I don't believe that. I believe that the ground is a solid boundary that's not going to be broken. I don't care how fast it's falling or how high it's falling from. I think there's a certain price at which somebody goes, hey, I can buy Comcast for, I don't know what they're at, 50 billion. Let's say they're at 50 billion now. And it's like, oh, I can buy Comcast for $40 billion. Suddenly AT&T goes, hey, I got $40 billion. Apple goes, ooh, I got $40 billion. I got $250 billion. There's a lot of people who wouldn't mind buying a huge corporation like Comcast if they got to the right price. So there is a floor. There's a very, very logical floor at which people start scrambling to put the money together to buy them out. Or a guy like Warren Buffett goes, whether buy him out or not, a guy like Warren Buffett goes, hey, I got $5 billion to put into Comcast. Those are value floors, especially to companies like this, where it's like, well, what's really going to hurt them? What's going to really impact their earnings? They're a huge multimedia conglomerate now with cable. And on top of that, they have, phone and cable concessions. So they've got a steady stream of income. They've got sports teams. They've got broadcast channels. They've got movie studios. These guys are not going anywhere. So it's a great long-term hold. Thoughts on Netflix short? Well, are we short on Netflix right now? I don't think we are. I'd like to be short on Netflix. Are they high enough to short? Or maybe we still have some short calls or something. I don't know. Do we have in the short-term portfolio? We might have some that are expiring. Amazon, Tesla. No, Netflix. Oh, yeah. I forgot about that. Well, they're at the top of our thing, but still it's March. I really think that there's we'll get back there. I mean, we got a 125, 110. Is it 110? Yeah, 125, 110 bear put spread. It's basically the same price we bought it for. And again, you're in a runaway market. Netflix didn't do anything right. We're just in a runaway market. The market went crazy up. In fact, frankly, considering how much the market's gone up since November, this isn't a really good game. So we were on track for our goal at 110, but unfortunately then the election happened and the market went crazy. But all they did is get back to 125, which is, I think, pretty much where we came in. Where did we come in? We came in on 1216. Oh, silly me. Okay. I thought we did that much earlier. Oh, so we came in here. Okay, in that case, you're being impatient. I thought that was an old trade. We came in here on 1216. It's at the same place. So no, I have no thoughts other than it's the same trade. Do you think the dollar will continue strong? I think I think, frankly, these Italian banks scare the crap out of me. So, and we're tightening, and Japan isn't tightening, and Europe isn't tightening. So there's no reason for the dollar to get much weaker. It's a little too strong, but not that much too strong. I mean, it's not like it should be way down or anything like that. I think the euro, though, you have to say 4% lower on the euro is a limit. And we're probably the limit here, and Canada's like at 75 cents. So these are some really nasty numbers for a lot of people. And don't forget these guys, the Swiss. They don't like it when the euro is too weak, and the Swiss bank starts buying euros, although they kind of shot their wad like trying to buy euros. Poor New Zealand's dollar is worthless. Everybody's money is worthless. That's why the dollar is strong. Everybody else is worthless. And that's not going to change unless they change their policies. We did change ours. That's why we're up so much. People started believing the Fed, and the dollar went up significantly. Now, I think it's a little too much. But on the other hand, I wouldn't buy euros. I wouldn't buy yen. I wouldn't buy pounds. I wouldn't buy Canadian dollars. I wouldn't buy francs. I wouldn't buy Aussie dollars. So there's not a huge catalyst to get it down either. I think probably in this range, around 100, basically in this range, from 98 to 102 is a good range for the dollar. It should be right about 100. So 103 is a bit much. So I would look for like at least back into this range. Back under 102 is what I'm looking for right now. And back under 102 is nice because it's going to boost silver for one thing. But nothing spectacular is going to happen unless somebody changes their monetary policy, and that's, not so far. With the Italian bank crisis, that's just not going to happen. Are you trading silver with 8 days left or SIG7 with 40 days left? I don't know. I'm trading the full contract. I'm pretty sure it's the G's at this point. Let's see. SI. Oh, here's how you find out. G7. If I punch in G7 and still have contract. Oh no! Apparently I'm apparently not. So the silver contract SIG7 is what? Is 1596, and regular SI is at 16. It's higher. That's interesting. No, this is March. Oh, it's not G. That's why. The default contract is March. It's SIH7. There you go. See, Thinkorswim doesn't screw you up. All right. So no, they defaulted to the March contracts. So in a lot of commodities, the quarterly contracts are the only ones that get traded. Well, not the only ones that get traded. The only ones that trade on a regular basis. So we shall see. Still on the Russell, the range you mentioned was 1380 down to 13. What? XX, please repeat that range. 1350. I'm just looking for 1350 as a trade. It's not necessarily the range. If you look at the Russell, it's a good time to practice that 5% rule, folks. Get your 5% calculators out. All right. Big chart. Well, speaking of big chart, let's take a look at this. So, on the Russell, $1,200 is a must-hold line, okay? We're miles above that, but that's the must-hold line, okay? That means we're working in multiples off the 1,200 line. So 1,320 is 10% up, and another 120 is 1,440, would be the 20% line. So those are the major moves we're looking for in the Russell. Where'd it go? There. Okay. So 1320 is the key line here. So ignoring this bullshit, ignoring it, because in the grand scheme of things, I don't care. 1320 is the line I care about, and you can see here, basically that 1320 wasn't broken until here. And you see that 1320 line? Well, let's go to the other chart. See that right at the 1320 line is where we had this little breakout consolidation and move up. So the 1320 line is the critical line. So then what we want to do is calculate the ups and downs from 1320. So it's 1320 times 0.975, 1287, which, like I said, is 1300. So basically, again, ignoring that. So basically, we're looking at 1300 as a significant line. It is, I know it says 1287, but you got to round off. Again, don't take these things so literally. Okay, we made it all up anyway. So for math's sake, we're going to say 1300 is the line that we expect to be a solid hold. And that makes sense, though, because see the rising 50-day moving average? By the time this falls, even if it falls pretty fast, it's still going to run into the 50-day moving average right about the 1300 mark. And that's a rising 50-day moving average. So it's kind of like when you put English on a pool shot. It's like you give it a little bit of a spin. This gives it a little bit of a kick up. So it's hard to break a rising moving average like that. See this one rising? Hard to break a rising moving average. Look at that. Someone whipsaw bounce off that thing. So either way, it's going to hit 1300 anyhow, all right? The top was 14. The bottom is 13. 1350 is halfway. So I'm thinking 1350, and you can see here we ran right into problems at 1347. So for me, 1350, and I bet if we do 1320, 1320, remember, was that 10% line, times 1.0125, 1336. So we have 1336 is the 1.25% line, and 1320 times 1.025, 1353. So that's right back to where we said. So 1353, or 1350, let's call it, is the next support. That's 5% above the 1320 line. And the 1320 line is a 10% line, so basically that's the 2.5% above. So it's the 12.5% line on the big chart. Okay, so when your range starts tightening, the 5% rule, it's just called the 5% rule. Within the 5%, the significant moves are 0.25%, 1.25%, and frankly, intraday, 0.675% is also, or 625% is also. After 5%, there goes 10% and 20%. 15% is not a big deal. So it starts off small, 0.625, then it goes 1.25, then it goes 2.5%, 5%, 10%, 20%. Those are the ones you really care about. After 20, it skips to 50. Although 40 actually does matter. But support-wise and everything else. So basically what we're saying, though, is that the move from 1,300 to 1,400 is 100 points there, and a 20% of the move retrace takes you down to 1,380, and a 40% strong retrace takes you to 1,360. Okay, so and here you go. Look, here's the 1,360 line right here. So clearly that's holding up. Okay, that's a spike down. That little number here doesn't mean anything. It's where it spikes to. Here's your 1,350 line, and we only sort of like airdrops to the 1,360 line. We didn't even hit 1,360 other than that little spike down that registered 1,354. So 1,360 has held well so far. But remember, 1,400, 20% retrace of 1,400, that's a strong retrace, 40% retrace, is 1,360. But then you have to recalculate again, because then inside this drop, the 40-point drop, now you're going to say, okay, well, that's a 40-point drop, then if this is strong, you expect to go over a strong bounce of this. So a strong bounce of this would be 8 points, which is 1,368 right here. and then a stronger bounce is 1376, and I'm sorry, that's a weak bounce. I'm sorry, a weak bounce is 1368, and a strong bounce is 1376. So basically, right here, 1376 is right where we are at the moment. So in this range. Now, if this starts holding up, 1376 starts holding up, then we are indeed consolidating for a likely breakout over 1400. But I think it's going to fail, and I think the whole thing. And then once it fails, though, then you have to start looking back and saying, well, okay, if that fails, then 1360 fails, then what's your next move? And that's where we get back to 1350 or lower. So that's what I'm looking for. But that's all it is. It's the 5% rule is all about you calculate the move from major consolidation to major consolidation. Then you retrace it or bounce, depending on what you're looking at, is going to be 20% weak, 40% strong. And within, you can go within and within and within if you want to track it closer and closer. But you always have to go back to the longer lines. You want to make sure you're referencing off of solid long-term lines, not just using the chart that you have in front of you. Follow-up question: how do you decide which silver is better? January, February, March? March, because the quarterly contracts are the fluid contracts that everyone trades. So if I'm going to trade, I don't want to trade one that's thinly traded. So I want to be in the quarterly contracts, just like everybody else is. Are you still short RB at 160? Good move down to CO, but RB holding. No, I wasn't in RB at 160. I just said I thought it was a good spot to short. I was already in oil, so I didn't want to bet oil and gasoline, and I liked oil better. So that's the way that worked out. Can't play everything. In fact, I don't like this. Well, I'm out of the oil now. I don't like this setup because I don't want to watch all this stuff. I don't want to watch silver and the Russell and oil. I want to watch all my indexes. I don't like watching different things. Okay, I'm not getting enough feedback from this. That's why this is easier on your eyes because you guys can't see it. But for me, I got a great big giant screen. It's all easy to see. Whoa, natural gas is flying. See why it's not a good short? But for me, I need to see all this stuff at once because I want to know what the dollar's doing. I want to know what oil's doing. Here's gasoline. Here's natural gas. Here's the Nikkei. Here's coffee. Here's silver. Here's gold. And you see, for me, it's logical. Like silver and gold, yes. Gas. My three energies are here. Coffee's here. It's just the thing du jour that I'm caring about. Which are friends who've been watching coffee for a while. And always my four indexes plus the Nikkei. And the dollar, of course. So this is my setup that I always have, and it gives me just general feedback on the market. Now, if I'm trading something particular down here, and coffee we're long in July, in the July contract, the June contract, the sevens, whatever. No, the sevens ends. I think ends or June. No, July. So, if I'm trading Apple today, I have Apple here. If I'm trading something else, I put it there. But this is my other, box. But these other 11 boxes are always the same for me. This is what I like to look at. And in this order, I'm very finicky. I get really upset if it's not right. So I go like Dow, S&P, NASDAQ, Russell, Nikkei, and here's my oil, gas, and natural gas, and here's my dollar, gold, silver, and other. And I think there's actually benefits to that. I think it's good to have, and Thinkorswim, by the way, in case you don't know, see setup, and it says save your workspace. So you just save your workspace. And that way, how Thinkorswim, sometimes you do an update and you lose your stuff, you can reopen the workspace. And it will save exactly like it is with all of your chart, all your, your time frames and your lines and everything else are all saved. Oh yeah, we're going to look at volume, right? Let's see, SPX. Okay, I can't really tell from this screen. Well, you can see, obviously, there's a lot more volume here than there is here. but it doesn't look that bad. It's actually, it's really from here to here, so like middle of last year until the beginning of the year, but not including the holidays. So here we are on the holiday weeks here, we're nothing, and this is where we are now. This week's going to be nothing just like this week was. But what happened when we had this nothing week last year? This is what I keep worrying about, guys. Okay, same pattern. Okay, here's your Thanksgiving drop. Here's the ups, 1, 2, 3. Then we have the low volume week, and here's the low volume week. And then the market completely collapsed in the next 2 weeks on rising volume. Why? Because you can't freaking sell. When you have a low volume rally, there's no one to sell to. So that's where we are. So anyway, if you have profits and you like your profits, then cash in your positions. At least some of them, half of them. Go to cash, have lots of cash on the sidelines, and the worst thing that will happen is there'll be a 10% rally, and instead of gaining 10%, you'll gain 5% because you have that freaking cash on the side. That's your worst case scenario. Your best case scenario, market drops 40%, you only lose 20%, and you've got all the cash on the side to buy stuff with. So the risk does not outweigh the potential reward. Therefore, you take the risk of having cash and cashing your positions at all-time highs. And not everything, like last week, we went through the long-term portfolio. We frankly liked so many of our positions, it was hard to cash things out. But by the way, don't forget that's because the long-term portfolio is already 80% cash. So there's very, when I say I like a position, it's like, I'm not saying it won't go down 20%, but I'm saying if it does go down 20%, I'm happy to buy more. Because we have tons of cash. We could double up every single position in that portfolio, and we'd still have cash. And it still made $140,000 in a month. So but when you make that kind of stupid money, you've got to get it off the table. It's not real. It's just freaking paper on a portfolio. It means nothing until you cash it out. Right now, you can cash it out at record highs because there's still people buying. But, when you get back to this, when this starts happening, you can't cash it out. Nobody wants your freaking stock here, or here, or here, or here, or here, or here. They had to wait until here, until people started buying again. And yeah, this was too dumb. This was stupidly low. But that doesn't mean it didn't happen. And this is what happens to you, because what you do is you say, you go, ooh, here, right, 2250. And here you're 21. So it's like, oh, it's just a dip. And then you go, oh, see, look, we recovered already. And then you go, oh, it's just a dip. And then you go, oh, no, it didn't recover. And then, oh, no, it didn't recover again. And then, oh, no, it didn't recover again. Because when you constantly have an up market, when things keep going up and up and up and up, you convince yourself this is how it's supposed to be. But in reality, we were at 2134 last year. That's a year and a half ago. Now we're at 2250. That's 5%. We're only 5% higher than we were 18 months ago. And people are acting like this is the greatest freaking market ever. A really great market goes up and up and up and up over time at a good rate. Not just bursts up from the horrible crash and that's what we do: crash up, crash up, crash up. So basically, the ups have been 5% more than the crashes since this time. So 1, 2, 3, 4 big crashes in 18 months, and you're betting that we won't have another one. That smart? You're betting that we won't have something that happened 4 times in 18 months. That's not smart. That's not good. Being realistic about what markets do, and be realistic about what this market's doing. This is a way overboard rally off a dip that was incorrect thinking on the dip. So we took back this dip quickly, and then we're overextending. That's all. And we'll be back here at 2,200. Possibly lower, but I certainly think we'll be back at 2,200 and start figuring out where the right price is, maybe back around this range. 2,100 and 2,200 is still the right price for the market, not 2,250 and certainly not 2,300. This is just silly. And by the way, I'm not just talking about the chart. I mean, read my article today if you didn't. It's silly because the price earnings of the Russell is 280. Was it 280 or 230? Either way, it's a ridiculous number. That's 230. You're paying 230 times earnings for the Russell. You're paying 24 times earnings for the S&P, or 23 times earnings for the S&P. No, 24. Well, and according to this one, it says 26. But you're paying a lot. You put it that way. You're paying a lot times earnings. These are large cap companies that are not growing at a rapid pace. Of course, they're not growing at a rapid pace because the GDP is only growing 2%. And the S&P is essentially the GDP. They're the 500 biggest companies on the planet Earth. And it's not like there's a big competition because the bottom 250 of the S&P aren't that big. Okay, really, it's like the top 30, 40 companies are something like a third of the entire planet's revenues of corporations. So they are highly representative of the GDP of the planet. And the GDP of the planet, let's say, not just America, the planetary GDP is growing maybe 4%, which is right in line with the 5% gain in the S&P over 18 months. So this is not a rally. There's nothing exciting about this. It only looks like a rally because we started off low. Had we just drifted normally higher between here and here, it would look exactly as lame as this looked. There's nothing very exciting about this going on. Dollar. Why do you favor? What is that? Favor? What are you, English? Somebody check his papers. Why do you favor oil over gasoline? Let's see. I don't favor oil over gasoline. I'm not sure what that means. We're shorting oil, and gasoline we usually follow. The thing is, there's a premise on oil. I don't have a particular. Here you go. Here's our bounce finally. All right. There's gasoline. First of all, gasoline's local. Oil is not so much local. Oil is international. Gasoline will go up and down on its own demand, okay? It depends on driving and so on and so forth. Right now, what's really supporting gasoline more than anything else is the fact that people are buying freaking SUVs again and Jeeps. Americans freaking love big cars and they love Jeeps. And as soon as gas got down to under $2, everybody started buying cars that get no mileage in it. Although the car, it's a 4-year decision. And you buy a car, it's a 3-4 year decision when you buy the car. And based on the fact that gas has been cheap for 6 months, they buy a car that guzzles gas. It's incredibly foolish and whatever, but what can you do? So that has increased the demand for gasoline, plus mild conditions. A mild winter means more cars and more driving on the road and so on and so forth. So there's a lot of little factors like that that affect gasoline, whereas oil is basically pretty straight up supply and demand issue. So it's a little more reliable to bet on. As you can see now, in fact, because like I said, I like gasoline short here at 160, but it hasn't gone anywhere while oil has tanked. So that's where it is. So it's not, and sometimes, by the way, I do like gasoline, I like going long on gasoline if gasoline is low into the weekend, and I think there's going to be demand on a weekend, then I like gasoline. So it just depends on which one has a better setup at the moment. I don't trade one thing. I look at all the different things that there are to trade, and I say, well, which one looks tradable right now? So, actually, you can do this. So that's all. Here's everything. And again, I'm not a technical trader, but I do know what the value of each one of these should be. So the VIX is too low at 1145. The Dow and the S&P, all these guys are too high. The NASDAQ least of all, because Apple is part of the NASDAQ, and Apple can take the NASDAQ to 5,000 on one good report from Apple. So if you find out that if somebody says, oh, iWatches are actually selling like crazy, God knows to who. I still do not know anybody who actually has an iWatch that uses it on a regular basis. Like there's nobody I know who I say, oh yeah, he's got an iWatch on his wrist all the time. Don't know anybody. A couple of people who bought one, and I think it's in their drawer by now. Anyway, and I love Apple, but I don't think that caught on. They seem to argue against that. They seem to argue otherwise, but I just don't see it. Maybe I'm in the wrong circles, but I can't imagine what circle they're in. Anyway, so the Dow. So when I say the Dow's overbought, I'm talking about thinking about all 30 components in their value, and I say it's overbought. S&P, same thing. We value the S&P once in a while, too high. NASDAQ is the least one to bet against, although we do have the SQQ hedge, but our main hedge is the Russell because, as we just said, the Russell is ridiculously overbought. The Nikkei is going to stay strong off a weak yen. They love having a weak yen. But, again, I think the dollar's too toppy, so I do like the Nikkei short right here at 19.5. I have no, Euro stocks. Europe is cheap compared to America. Now, here you got to go back to weeklies. There you go, see? So Europe hasn't gone anywhere at all. The DAX has taken off a bit, but that's not a huge bump. Well, 10%. So the DAX is up 10%. The Euro stocks themselves, though, are basically flat to where they were 18 months ago. We're from 1900 to 2200 is like 15%. So we're up 15%. DAX is up 10%, and the Euro stocks are up 0. So therefore, Europe is a relative bargain. So I certainly wouldn't bet against Europe. And by the way, that makes it tricky. Now, I would bet against Japan. I would not bet against Europe. But that makes it tricky because Europe has got to lead it every morning. They're up before we are. They're trading before we are. And if they keep catching up to us, they're going to be giving us a little boost every morning because they're buying to catch up to us. Then they come into our trading day. They're in the process of buying. They start buying the U.S. Now, because Europe's up in the morning, they'll start buying American stocks too when they open up. And then we look bullish, and then our traders wake up, and our traders go, oh, look, Europe's up and our futures are up. Let's buy some more stuff. So that's a self-feeding loop, which is one of the reasons that we're being driven like this, because they are so far behind as they catch up. And also now Asia was catching up too. But now Asia's overbought now. And the whole thing's going to collapse soon. Anyway, we talked about the oil, gas, and whatever. Brent, of course, and WTI are on very similar paths. Oh, in fact, today, I wonder if you could see that. I think Brent has a significant lead today. No. Oh, okay. I'm sorry. I thought Brent fell down before WTI did, but it didn't. They're pretty much neck and neck. So he's bouncing off 54.50. He's bouncing off 52.50. Like $2 apart at the moment. I'll go back to Dave. So anyway, natural gas, gold, silver. Gold and silver are beaten up because of the dollar. but they're both good buys down here. Platinum, copper, weird. Cattle really took off, man. Holy cow. Really, both kinds of cattle took off. Hogs took off. Corn is down. That's good. Soybeans down. That's good because you got to feed the cattle the corn. Oats, rice. Ooh, rice is taking a bath. Soybeans, wheat, cocoa, cotton, coffee. We're still waiting for coffee to make a big move. I like coffee long. I like coffee long all the way back to this 160 line. Easily 150. I mean, some big money to be made there. We have long, like I said, long July contracts. Sugar's cheap too. Sugar's a good deal right now. 30 years, they fell off the table and crashed, but here's where I think we have support. Having 10 years, same thing, doesn't matter. And then the currencies we just talked about. So, you know, I just look for whichever one has the best setup that seems like the easiest story that's going to work. So it's not like I favor one thing over another. Every day I look over everything to see what's tradable. And that goes, of course, for all the stocks and options too, because we trade plenty of those. Oh, look, all the indexes are moving up a little bit now. Could we go green? We are green on the Dow. We're getting there. We might make it. Ugh. Okay, where are we? Would you pick, sorry, how much of a pullback are you looking for in 217 bottom? I don't know. I mean, look, you have two uptrending moving averages. So 2150 here looks like it's going to be very supportive. And we have great support all the way across here on this line, 2150. So I think it's going to be hard to fall below that. So we're not even talking about a big correction. It's not even 10%. And here you can see the 200 days. So by the time it gets down here, this will be an uptrending 200-day moving average. It's going to be hard to break through. So without, an exhaustion rally, yeah, it's going to correct 100 points, no problem. That's 5%. Going below 5%, not that likely. Not without something bad happening. Now, something bad is happening. The banks are collapsing in Italy. So, we'll see. If they do fall apart, and then if it catches on in Germany, then we could be right back into a 2008 situation again. So we will see. But barring something tragic, 5% is what I'm really expecting. Looks like the end of 2015. Yes, it's very much like last year. I wrote an article on that. I forget when, but I just wrote an article about that, how we're following an incredibly similar pattern to where we were last year. Oh. What's it about slopes and weeklies? I'm confused. Don't you look at the upward slope of the 40-weekly SMA of the SPX? Yeah, we just looked at that, right? I mean, that's the 200-day. I'm not, it's a 40-week, but it's still the 200-day realistically. Because 40 times 7 is what, like 28. That's bullish. Okay, that's definitely bullish and supportive. But this was bullish and supportive too. And we weren't even that overbought when this happened. Now we're pretty damn overbought. Didn't even bounce. Had no respect for this line whatsoever and collapsed. So you never know. You got, again, trading purely on technicals, you can get yourself killed 1,000 ways. You see a good entry from Microsoft on an options play? I'd say no. Didn't they just hit an all-time high? I mean, I like them and all that, but I ain't going to pay that kind of money for them. So, here, let's see if we can do this. MSFT. 2.5% dividend, P30. Oh, really? Earnings per share, $3. No, I don't know where they're getting 30 from. So you can't trust Yahoo. So they're making $3 a share, and it's $63. So that seems like a P of 20-something to me, not 30. I don't know where they're getting that number from. But anyway, so they're again, 20. Nobody ever paid 20 for Microsoft. Well, I mean, when, in the old .com days, but nobody paid $20 for Microsoft before. I mean, I wouldn't bet against them, but I mean, they're a good company. They're a freaking cash machine. I think this virtual reality is going to provide a kick to a lot of people. I think they're very, very aggressive with their stores, and they are getting their products out there. So I wouldn't bet against them, but I don't see why I'd want to jump on now. But on the other hand, if you do feel the need to be in, the way I would look at it is say, okay, how much would you like to buy them for? That's always step one. How much do you want to buy the stock for? They're at 69 now, 68.50. So we go out to 2019 because that's going to give you the most premium. And that's very reasonable actually. You can sell the $55 puts for $5.50. That nets you in for less than 50, for $49.50. Now, do I want to buy Microsoft for $49.50? Sure. $49.50 is way the frick down here. Or here, basically, okay? Like the lows of the year and the highs of last year, and it's a good support line. Yeah, I can do that, all right? So there you go. So if you're going to play Microsoft, that's how I would play it. I would sell these puts and see what happens. Now, if you want to take a bit of a risk, I wouldn't, frankly, but okay. But if you want to take a bit of a risk, you can sell these puts and then buy, let's say you think it's going to go higher. I can't. I'll say it's not 68.50, it's 63.50. Good eyes. I do not endorse this in any way, shape, or form, okay? But basically, I would just buy a bull call spread like the 62.50s, okay? So you're in the money a little bit. And those are, no, I don't like those. Sorry. 10. Okay, let's say these are 60s for $10. All right, so you buy the 60s for 10, and you sell, don't want to be greedy, so you sell the 67.50s here for $6.50. So now it's $3.50. So now you bought a $7.50 spread for $3.50. So you're going to make 100% on that spread to get the short calls, and you also sold the calls for $5.50. So your net is a $2 credit on a $7.50 spread. So if you have a $2 credit on a $7.50 spread, that means you make $9.50 at 70 based on that play at 67.50. So all Microsoft has to do is go up a few bucks, $4, which is 15%. No, not 15%. Sorry, it's like 7%, 7 or 8%. So all Microsoft has to do is go up $4 in the next 2 years, and you make $9.50 off your credit. And the only thing you're doing, and the only downside to that is you're offering to buy Microsoft for net. You have a $2 credit now. You're offering to buy Microsoft for net 53. So if you want to buy Microsoft for net 53, that's a great way to play it. Okay, it's a really good way to play it, and if you like it, you love it. Frankly, it won't go in my long-term portfolio because it's just not cheap. If Microsoft dropped 10%, I would love to do a play like that, but I would do it with lower calls and a better put spread. Lower puts and a better call spread, and make something out of it. So in other words, I keep it on a watch list. I do like the price of those options. They give you a good return, but I don't like buying. I don't want to buy Microsoft when it's high in the channel. They'll mess up. They're a big company. They'll screw something up and drop one day. I can be patient. Why does the spread between oil and Brent sometimes wide and other times narrow? Is there a usual spread? There is a usual spread. The usual spread is around $1.50. And why? Well, first of all, they're not the same thing. We have different laws than they do. If Trump's coming in and he's going to ease off on fracking, then theoretically there will be more WTIC oil. And if there's more WTIC oil, then there'll be more of a glut here than there is now, which means the prices will probably drop more in the U.S. than they do in Europe. And if OPEC cuts production, then that's going to raise the price of Brent more. That's going to raise the price of our oil because what do we care what OPEC does? We don't buy any oil from OPEC. This country, I'd be surprised if we get 1 million barrels a day from OPEC. I very much doubt it. In fact, I'd say it's more like 300,000 barrels from OPEC. And frankly, it doesn't matter to us where oil comes in from an import basis. It's just oil is shipped from all over the world to all over the world, and you don't have a lot of control over where it's coming from, so some of it probably comes from OPEC, but not significant at all. So there's nothing that happens to Brent crude, which is, Brent crude is mostly OPEC oil, and of course, obviously, the Brent is the North Sea oil in Europe. But that's just, they have different geopolitical concerns over there, different things happening. If there's a war, if there's this or that, if there's actions, environmentals, everything's different in different parts of the world. So you just, one will sometimes move up when another one doesn't for whatever reason. But generally, they tend to drift because on the whole, everyone ships to everyone else, and oil comes in from here and goes there, and it's a globally traded thing, so it's going to eventually find its point. But CL is our local oil, so the main difference that you're paying is the shipping cost. Okay? It's cheaper for us to buy WTIC oil because it's made here. It doesn't have to get shipped on a tanker for 3 weeks. So that's most of your spread is caused by that. So would you recommend selling front month calls against a short-term position, or is that too dangerous? A short put? Whoa. Without a backstop, no. You're describing the butterfly portfolio. We always sell front month calls, and we have short puts because that's our entry position. But you can do it, but you can get screwed like that. So it's just a matter of it's like doing short strangles. It's like you have to be lucky a lot in order to make enough money to make it worthwhile. Now, go back to Microsoft, right? See, the thing is, if I'm selling a short put, so I sell this put, and you're saying, okay, well, so great. So I basically essentially have this position, and I got $5 worth of cushion. So therefore, if I now sell the March 65 calls for $1.70, now I've collected the $5.50 for the short 55, plus I'm collecting, what was it? Damn it. Okay, plus I'm collecting $1.70 for the March 65. So that's 550 plus 170, 620, 720. So I'm collecting 720. So the trade's a winner as long as you don't have to pay back your short call of more than 720. But meanwhile, you're putting yourself in danger on the $1.72. This wasn't in danger. Now, you're also saying, oh, well, but if it goes down, you got a buffer. But it goes back to the same thing, though. I'm not agnostic when I play. I don't think Microsoft's going to be below 55. So if I just leave this alone, I'm going to collect my money. Here, I'm just taking a risk. So to me, it's two different plays. It's not one play because the long call, first of all, the long put's not going to save you. The long put is what it is, okay? It's not going to make or lose, it's not going to make enough money because of the low delta. It's not going to make enough money on a move up to salvage the money you lose from the short caller. Okay, and also vice versa. If it drops significantly, well, if it drops, actually, that might help you. If it does drop, the short caller will save you, frankly. But if it's going to drop, I mean, if I'm playing for it to drop, then why would I have bought the puts in the first place? Why would I have sold the puts in the first place? So to me, it's a little bit betting against yourself. It's it's like if I'm bullish on Microsoft, then I'm not going to sell short calls, especially naked short calls. That's kind of crazy. I'll sell the bull call spread. Not sell it. I mean, I'll buy a bull call spread, but I don't want to sell it. All right, so hopefully that makes sense. Look, having been burned enough times over the years, I can just tell you it's a bad idea. Okay, they call it's like they call them black swan events, and this is a very sad thing because a lot of these. I know a lot of market sites, they talk to you about these things. They, unless there's a black swan event, ha, 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 as if it never happened. All right? But here, look at Microsoft, okay? How often does Microsoft move 20%? Well, that's a 20% move. That's a 20% move. That's a 20% move. That's a 20% move. That's a 40% move. That's a 20% move. So in 1 year that we can see, well, no, sorry. All right, well, in 2 years, basically, there's another 20% move, another 20% move. So 1, 2, 3, 4, 5, I'm going to count that twice, 6, 7, 8, 9, not even going to count that one, 10, 11. So in 2 years, 11 20% moves on Microsoft. 11. That's every other month a black swan event happens in Microsoft on the average. Now, you are going to play Russian roulette by selling the, and screw the puts. I don't give a shit about long puts. That's your position. That's a totally different trade. That's just being long on Microsoft. You're going to sell these calls that are 2.5% out of the money, giving them 3 months to screw you for $1.72. Whereas if Microsoft moves 20%, it'll be at 75, and these calls will be $10, and you'll be down 500% on these calls. That's if one black swan happens while you're trading it, and you're already giving them 3 months, and it happens every other month. That's why you don't do these things. It's not a statistics class. You have to look at the reality of what happens. Okay, I know, I mean, it's very sad because I know a lot of these guys who teach options courses and things like that, and they get big money for their options training, and they say, oh, statistically, blah, and the S&P history. There's no S&P history. It's what's happened in the last 2 years is history. How volatile has this stock become lately? And so when I see something like that, you have to guard against it. So when we had Microsoft in the butterfly portfolio, we might even still have it in the butterfly portfolio, I don't remember. But when we had it in the butterfly portfolio, we had protection. Because that kind of stuff does happen with Microsoft, and you've got to protect that position. It's not like Comcast, which barely moves. Now, yeah, we still have it. Now, what do we have with Microsoft? We've got the long 6250 calls, so that's pretty tight protection, right? We've got the long 6250 calls, and we've got the long 42 puts. Now, why are the puts so much further out than the calls? Because the calls are on the money, and the puts are a mile out. Why? Because I don't really think Microsoft's going to go lower. So I'm not going to pay money. At the time we paid, notice we paid $5.80 for the calls, we paid $3.30 for the puts, so we paid almost double for the calls and the puts. So clearly, at the time, we felt Microsoft was much more in need of an upside protection. Then we sell the puts and calls in between. And look, we even got burned on because we sold in January 57.50s, and they're at 63, so we're $6 in the money. So we owe this guy $6. And we only sold them for $4.80, the puts and calls. So we got burned right there. In this particular one, we got burned. All right, so it's a tough butterfly play to trade. to do it naked without even protection would be crazy. I got stuck with PSO a while back. It's down $400. Sell it against gains or keep it for next year. $400. I don't know what that is. PSO. While I'm answering this question, I'm probably up and down $400 on a futures contract. Hang on, let me ask you, what is going on? Nothing. Hey, look at that balance. Slowly but surely, we're getting back to a point where we can sell again. All right, PSO. I don't know. What's the question? I like it. I don't understand $400. I don't know how many you have or what you're doing. We think we think this is a great value. They're a big dividend payer. They're a steady company. They're just down in the dumps right now and restructuring. It's a long-term play, though. So if you're looking to win big, and again, if all you have is a stock and you're looking for a giant recovery soon, no, then I wouldn't play it. We're playing it because we like the options. We have it in the long-term portfolio. I think we have it in the options opportunity portfolio too. Yeah, here's PSO. Oh, this still has this hasn't been adjusted. Maybe the options opportunity was adjusted. Let me see. Probably not, though. PSO. Yeah, where'd it go? This Frontier. Oh, I thought we had them. Oh, my bad. Okay, anyway. But we're playing it because they pay off a nice dividend. PSO is not available. No information is available on these guys. Dividends only. Fine. All right, so the last dividend was August, and they paid 23 cents. So hopefully they pay that much again. Oh, there it is. Yeah, so they're scheduled to pay 47 cents. So they're paying like a 4.6% dividend. But you say you're down $400. It either means you have very little or that you just got in and it moved pennies. I don't know, but I like them for recovery. But the way we play them, as I was saying, in the long-term portfolio, is we don't play them that way. We play them with options. And what we did is we bought 1,000 shares. We sold 10 of the puts, and then we sold. Now we sold 10 of the June puts, June 10 puts, and they're right at 10 now. So we sold these guys these puts, and then we rolled them into these, but we didn't have to cancel out still. And when it bounces, we'll sell calls. So in addition to the dividends, we're picking up. This is a huge amount of money, $1.35 for puts. So in 6 months, we sold $1.35 worth of puts against a $12 stock. That added 10% to our overall returns, and that's how we play it. But again, if you're playing a small amount, it's really not a good stock for that because it's not worth. It's almost not worth playing if you're playing a small amount. Have you filed on the trade of the year? No, I'm so stuck. I'm looking at DBA. I'm looking at silver SLW. I'm looking at Barrick Gold ABX. I think those were the top contenders. It's a really tough call. It really is. But commodities, basically, so something in commodities. And the thing is, I always do the secret Sanchez inflation hedges anyway, so all those qualify for the inflation hedges. So I don't want to be redundant, and I certainly don't have the secret Santa and the commodities. But I cannot find a stock that I believe in enough, especially ahead of a crash, and until I see where we finish up next year, I'm not into buying a stock at these prices. So it's going to be tough. A lot of thinking involved. I was assigned at 12:38, now 10:16. If you like it, sell some more, put some weight until doomsday. All right, you assigned at 12:38. LTP update to June 750 calls were sold for 235, not reflected. Oh, thank you. Okay, good. Well, so there you go, though. So if you were assigned at 12:38 and then you turn around and sell the 750 calls for 235, now you're assigned at 10. And then yes, I would sell the $10 puts too, and that knocks another dollar off it, and then you're netting into $9. And that does get exciting, doesn't it? At a certain point, that's kind of interesting, because think about what you're doing is you're accumulating the stock at lower and lower prices. I mean, if you start at 12:38, you get assigned 10:18, okay, and I assume you sold some calls or something along the way, but you sold the puts, obviously you wouldn't have been assigned. So you got assigned at 12:38. So if you got assigned at 12:38 net, and now you sell the June calls for 235. Is that what the number? 235. So you sell the the 750 calls for 235, and you sell the $10 puts for another buck or whatever it is. Now you've dropped your net from whatever the hell the original was. Maybe it was $15 when we started looking at it. Now you're netting at $9. And yes, you have the 750 calls that are being sold, but by June you're going to roll those too. But eventually, you should roll out of trouble, right? I mean, eventually what happens is we keep doing that, you keep lowering your basis, and eventually when you do get called away, you're going to be happy. And frankly, if you happen to luck out, and that's what we do sometimes, when we luck out and we sell these calls and then the calls expire right on the money worthless, we might say, we might have a basis down at like $8 and the stock's at $8, and we say, you know what, why don't we wait and see what happens? And then it goes up to 10 or 11, then you start selling some calls, and then you start having a business. That's exactly how we do scale into something in the long-term portfolio. That's the idea of it. It's like we didn't only want to have 1,000 shares of Pearson, because our allocation blocks is $50,000, $100,000 in the long-term portfolio. So it wasn't like we only wanted 1,000 shares. It was just our first entry, and we said, well, if they go down, then we're going to be happy to double down and buy more. And that's where we are now. So we're at the point now of, I think we did double down. I got to go check, but we're at the point now where we either double down or we sold puts that we expect to double down on, and then we'll have 2,000 shares, but our net will be down to like $10. And then frankly, if we have 4,000 shares and our net is 750, I'm going to be thrilled. I'm not upset about that. We want to have 4,000 shares at 750. Yeah, I got to add all that stuff. The problem is it takes so long. It's such a tedious process to update these portfolios. So that especially like last week, we did a lot of stuff. Because options expired on Friday. I didn't get caught up this weekend. I was away, and it takes me really a day to do all this stuff. So hopefully this weekend I'll be able to get to it, even though obviously my kids are going to, we got Christmas stuff too. So we'll see. So where are we? Okay, we're going to have to wrap this up shortly. So this is what I was talking about before. It's very important. We started the seminar, if anybody remembers, we actually started this thing off looking at the oil. So we're in the silver. That's still just hanging out at 16, so nothing exciting there. This is where I got out. I got out at 52.60 because I didn't want to, at the time it was here, I didn't want it to bounce up to 75 and me lose $1,000. I had 5 contracts, and then especially if it bounced up to back to 53. But now we're above where I sold, so now my plan worked. Even though I could have made more money if I waited, I was impatient. But now, if it bounces back up here, I'm going to have a better basis than where I just sold, and I'm back in the saddle. So now we're waiting until. We're waiting to see where it finishes off. Now, if it runs into trouble at 75, that's the weak bounce. That's going to be a very bearish sign, so I'm going to certainly want to add a couple of contracts there. I probably had 2 or 3 at 75, assuming 75 looks like it's failing. And then if it goes up to 80, I'll be very happy to double down on that. Not 80, I'm sorry, if it goes up to 00, and I would average in then at 87.50. So I've got the whole plan, waiting for it, and all it was it bounced. It went further down than I thought, and it's being slower than I thought to bounce. But that's exactly what happened. But I took a nice non-greedy exit and got my price on the way down. That doesn't happen. If I missed it, if I was wrong and it bounced back up on me, I would have lost, $500, $1,000. Why should I even consider risking that? It's not worth it. And a big mistake a big mistake people make trading options, trading futures, is this woulda, coulda, shoulda stuff, Because they get out early and they say, oh, I could have made another $1,000. And then next time, when you should be getting out and making sure you lock in your $3,500, they act like greedy assholes. They don't get out and they lose their $3,500 because they wish they made $1,000. It's a terrible attitude. You can make this money every single day and lock in your profits. And the better you get at locking in your profits, the more often you're going to make profits. Now remember the other one on the Russell, I said I'll let ride. And again, because I have a $3,500 buffer here, I was happy to let the Russells ride, and now they're starting to pay off again. But you've gotta have a discipline. You've gotta have it, and this goes to the options too. The thing I like about futures trading, especially for people who are learning all this stuff, it's we talk about this. We've been in fact this is a futures webinar. The way this is going, we keep talking about the futures because it's like a high-speed version of learning options. It takes you months, years, many years to get this much trading time in playing options. Unless you're day trading options, which I frankly hate because you're churning fees. But with the futures, they're very low fees, and you get the practice of seeing all this stuff happening. But when you're in an option contract, in fact, here, let's take a look. I'll show you. All products. So on these Microsoft, okay, so let's say we decide to sell these April or March puts, right? So I'm going to copy Microsoft, that's the code for these puts. And now I go back to active trading, and I'm going to put it in. So I'm just going to paste it in there. And watch this. Look at that. It does the same thing. We always talk about legging into positions is better, right? So if you get good at this, you'll get good at this. And you'll know when it's a good time to buy an option, and you can, by the way, you can put your price in. I'll do it, but I'm going to cancel it. 10, what are you kidding? So you can put your order in and leave it. Or you can say, look here, here's a lot of, I can fill this easily as 100 buyers, right? There's 100 guys, there's 70 buyers. I can easily fill this price. So you see what your prices are. Don't let Thinkorswim tell you what the prices are. Look at them. Look how much demand there is. Look how much interest there is at every level. And you can see, okay, this thing ran away. Now, of course, you want to then look at the Microsoft chart as well. Now I'm messing up all my charts, but okay. So then you look at Microsoft while you're looking at it, and you say, oh, I see. Okay, so here's what's going on. And then you decide what you're willing to execute. And you can put up all the legs of your spread that you're thinking of executing in all your boxes, and you can decide where your best chances of execution are going to be on each leg. And you can monitor it until you fill your legs. Or you can just set it up and walk away and say, okay, these are my ranges, so I'm going to be watching. You can take a screenshot, and you can save your screenshot so you have all your markers set. Hey, there's all kinds of ways to do this professionally and do a good job of watching your legs and making sure you get in. But that's why I like the futures, because the futures train you to do this. Because this is a big deal, okay? If you learn that you don't have to pay $189 and you can get $170 or $165 instead of $189, that's freaking 20 out of that 10%. That's 10% difference. Those are the same skills that you're learning when you're trading the futures. It's a 10% difference on your options entries. If you learn how to do that stuff, you will make much, much more money. It's a huge advantage, especially if you make 10% on your entries and 10% on your exits. You will do very, very well trading options. It's all there for you. All this information can be drilled down. And frankly, if you don't do it, you're at a tremendous disadvantage to the people who do. There's no professional traders who aren't looking at these screens. Yeah, before I get upset, I'm going to put it back. Dollar and silver. And we have the Russells and we have oil. Okay. So like I said, I want to get back in here, and it's frankly, it's so weak, it's like tempting to get back in right now because it's not looking good at all. I still want to be short on oil. I am long on silver, and I am short on the Russell. That's where we're going to leave it. All righty, so that's the end of this exciting session. Let's see. Sir McClellan says, I need a job, I'll do it for 3 months. If you say free as in no charge, you could be hired. How do you determine when you're going to... Actually, you know what it is, though? But because by doing it, it forces me to, like, review every single position very intensively. So, see, that's the thing. Some jobs, as a boss, I learned this. Some jobs, you shouldn't hire someone to do. Because if you do, you lose track of the job. It's a tricky thing, especially when you have a big company. Because it's like some things you need to do. What I used to do is I would, which used to really freak the employees out, though, I got to tell you. But I would spend, like once a week, I would try to spend a day doing somebody's job. So like if somebody was sick, I would fill in for them, or if somebody needed help, or somebody needed, especially if people need training, I would train them. And of course, that puts horrifying pressure on them, and I'm a bastard trainer too, so it's not good. But the point is, it was good for me because I would always have my finger on what was going on in like the field. If people are working, I'd know what the programmers are doing. I would know what the secretaries are doing. I knew what stuff was going on in the office. So, you know, because I'm writing these programs that I had, 50, 60 people doing data entry on. But if I'm not doing the data entry, then how do I know if it's really working? So sometimes I would do data entry for a whole day, and you do data. Believe me, you do data entry on a program, you have a totally different perspective on it than the guy who's writing the code. so it was, so I would realize, like, I would then go back and have a meeting with the programmer and be like, oh, did we screw this up? I said, this takes forever, and this is too slow, and this is annoying, So then it helps you do a better job as a boss by getting back down there. So anyway, so that's kind of what this is. It's like I need to do that kind of grunt work, unfortunately. I wish I didn't, but it's the kind of grunt work that just, it forces me to look, the way I just looked at those contracts, I have to look at every single contract, I have to look at how the contracts move, watch what they're doing, see how they're performing, I have to look over the company really closely, and if I job that out to somebody else, all I would do is lose touch. So that's unfortunately not a good thing to get rid of. How do you determine when you're going to double down on a future position versus taking a loss and getting in lower? Depends how much conviction I have. It's a fundamental thing. It depends on why is it down? So in other words, oil, today, in fact, we had a discussion in chat today, because oil went up first, oil did a weird thing. Here's the oil report at 10:30. Okay, so see this spiky thing? So oil went down, then it went up, then it went down, and Craig and I were talking, and I was saying, look, I said, because there was a big drawer in other oils, but I said to Craig, I said, nobody cares about other oils. Nobody looks at that stuff. So that we look at it because we're crazy. Okay, we're geeks on this thing. But normal people don't look at it, and I mean normal people, including traders, don't even look at this stuff. So we're watching these things, and I said that's not what you base this on. You have to base it on what's actually going on and whether or not this draw, the headline draw, was big enough to justify not this move, okay, but this move. Let's get back to energy. So it's this move that had to be justified. 46 to 54. Does this oil report today justify this 20% move in oil? And no, it doesn't. It certainly does not. This is way, way overdone. Okay, and also the other mitigating factor today, now we go to the hourly, so you look at today, this went up. What was the mitigating factor this morning? Was the dollar had dropped from 103.60 to 102.80, which is almost a 1% drop on the dollar. So the strength of oil, in the same amount of time, oil went from 53 to 53.60. Oil went up less than the dollar went down. That's weak. Oh, by the way, what did I say about 1.25%? 1.26%, right there. So oil went up less than the dollar went down. And screw that thing. That doesn't mean anything. That's from the opening of the futures here, so that's not the point. The point is, here we were midday yesterday, here we are today, and oil was not up 1%, even though the dollar was down 1%. So that's mitigating factors that made me feel that the move in oil was weaker than it looked, and that it should be remain short. So we discussed it, and we decided to remain short, and obviously made a lot of money. But and by the way, doubling down on futures is really, really dangerous. Okay, if you're learning, I don't know your financial situation, but if you're learning, the thing to learn is to stop out. That's what you need to learn. The conviction trades, what I do is really, aside from being really advanced, I in fact on the Russell, I was down like $40,000 last a couple of weeks ago. I got it back, but you can get in huge amounts of trouble with those trades. And if you are trading an amount of money that's going to in any way, shape, or form affect your lifestyle, you shouldn't do it because you start making bad decisions. All right? Like with the Russell, okay, look, I'll say it even though it sounds like braggy or what. I don't want to make it sound braggy, but I mean, I got to tell you what the fact is. So with the Russell, if I lost $40,000, all it means is that Maddie, my daughter, would instead of getting my car, and I'm going to get myself a new Range Rover. Instead of getting my car, I would keep the car I have, and I would buy her a cheap car. That would be the only difference in my life for that. I would basically offset my loss by doing something cheap. Usually, if I lose $5,000 or $10,000, I say, okay, we're not going to go on this vacation, or we're not going to buy the new TV. You know, I always try to offset it with a current expense, with cash expenses, if I make a loss. And I would never trade anything that caused actual harm in our financial situation. We're just talking about like little things that we buy or sell that make a difference. So for me, that threshold is pretty high. If $5,000 matters to you, then trading 2 or 3 futures contracts is a lot, and you really should be very careful about doing it. Because you can lose $5,000 with 4 or 5 contracts in a minute. You could actually literally go to the bathroom, come back, and be down $5,000. So it's much more important to learn how to do small trades, how to set tight stops, and how not to get in those situations. Learn that first before. And because with the Russell, and we talked about this last week, so I won't get into it again. But with the Russell, here's where I started shorting it, up around here. I was wrong here. Somewhere around 13-something, I think we started shorting it. It went up. I doubled down. I got out here when it went up. It went up again, and I got in trouble. This is where I got in big trouble, but because I stuck with it and didn't capitulate, I got my money back on the dip, and now we're okay. And meanwhile, these are days, so during these days, if you look at the hourlies, even on an up day, there were times when I was able to go, like, I bought more, came back here, sold, bought. So this day shows as an up candle, but the reality is it's actually a good day because I got my dip, and that let me reduce. Then I go back in, I get more, I get to reduce again. Every time it has a nice dip, I get to reduce. Here, obviously, these are all good. But I was in trouble in that position. Now I'm back to like a normal amount of Russells because I'm basically, and frankly, for all that trouble, I barely broke even. So I mean, it was a huge hassle. It took weeks to unwind the position, or a couple of weeks to unwind the position, and it was painful. I was not happy. And obviously that's extremely unusual to get a move like that, which is why I started trading it anyway. I mean, I just really didn't see any justification for this move, for the day move. So this happened. I said, oh, that's ridiculous. It's going to go back to 1250. It never went anywhere near 1250, and I got screwed. So now I'm just hoping it goes back to 1350, and I'll make some nice change on this one. But again, it's because I have this strong conviction that the Russell is extremely, extremely overbought, and even if it went horrifyingly against me, which it did, I don't mind sticking with it. But again, I don't mind sticking with it because the loss wasn't a big deal. It was like more money than I would want to lose if I went on a trip to Vegas. I'd be furious about losing $40,000. Anytime I lose $40,000, I'd be furious. But on the other hand, there are times I make that much money too. So you have to have that perspective also in the grand scheme of things. But again, the loss of $40,000 would not change anything in my household or in my life or anything else. You cannot play with money that stresses you out because you will make very poor trading decisions and you will end up going into like a very bad spiral. That's what happens to gamblers. Okay, people gamble over their heads. They get in huge amounts of trouble and they can't dig themselves out of it, and then they make bad decisions and get into worse trouble. Super not advised. Okay, so I don't want that to be taken lightly. Okay, it's a very advanced way to trade. And it's also it can be very dangerous. And if you don't have very strong conviction and you're not determined to stick with it and you can't absolutely afford the losses, don't do it at all. So that's my final word for the day. All right, guys. Well, thanks everybody for coming. We shall do it. Oh, will we do it again next week? Where are we at? What's my calendar like? Oh yeah, the 28th. Sure, that's not like New Year's or anything. We can do it. We can deal with that. We will do it again next week then. Okay. Thanks, guys.